So we got exam on Wednesday, 30 minutes. So we're only going to be doing the exam for 30 minutes, then we'll have regular class. So exam question 1, you'll send in. It's already out there on Blackboard. In fact, I think I've already gotten 1 or 2 submitted. And then we'll do question 2 on the first part of the class on Wednesday. Just a reminder, I showed you question 1 example last time. So just to show you, it's not 2 paragraphs. Oh, lo siento. So, it's a significant answer. You've been working on this 3 or 4 hours a week for the last 4 or 5 weeks, so it should be a pretty substantial answer. I did used to do this in class where you had to do it off the top of your head with no notes written, so you don't have that issue. Here's another one that's kind of similar. He did it into 2 columns. You definitely don't have to do that. Define investment portfolio. Why are you investing? What can you invest in? There's parsimonious. There's an investment horizon. He even highlighted the words he knew I was looking for. How are you going to do it? He did that. Then he got into the major asset classes. Some students forget to compare cash versus bonds, but he did that. Reinvestment risk, price risk. Then he talked about cash equivalents. Then he talked about bonds, DC cuts I, duration. He talks about the 3 asset classes, sub-asset classes, short-term, intermediate-term, long-term. He has the formula in there. And then he gives a strategy. If you expect rates, convexity, same way, even put some graphs in there since it's open book. So he goes through the entire DC cuts I. Then he does equity, and he starts off with introduction in equity. Talks about the expected return, doesn't do quite enough on the expected return as far as the economic side of that. So he left a little bit there. Then he does bucks, beta. Talks about cyclical versus defensive, US versus non-US capitalization. And each one of them, he gives a definition and he talks about the strategies, which is really important. When do you want large cap? When do you want growth stocks? Then he did alternatives at the very, very end. Probably not enough on alternatives, where he probably lost some points on alternatives. So you should talk about real assets, talk about venture capital, and go through each one of those. But that's what we're looking for. And then question 2. So y'all tell me. What's the first thing you might talk about in question 2? So you might do stocks versus bonds. What are you looking for there? Yeah, so you're really looking at what's the one key there? Is it inflation? Is it interest rates? What's the one thing you want there? Huh? Yeah, so economic growth. That's what I call quality. You want some kind of, is the economy doing well or doing poorly? If the economy is doing well, let's invest in stocks. If the economy is doing poorly, avoid stocks and buy high quality bonds. All right. What else might you talk about? What's probably going to be on my list? You remember what was the first thing on my list? Yeah, so treasuries, maybe they're long term, but there'd be treasuries, short term, long term, and you're going to talk about how many things under there? Two things. So what are the 2 things? Duration and quality. So the boss is going to tell you, and I found my I found a really good source for the scenario. So I'll tell you who it is after the exam on Thursday. I'm on Wednesday. So I didn't copy it word for word, but I'm definitely using their scenario. It's a famous organization, so we'll see. So treasuries, so are rates rising or falling? If they're rising, you want to, if you're expecting them to rise, you want to shorten duration. If you're expecting them to fall, you want to lengthen duration. And quality, again, economic growth. Usually those go together. So if you're expecting slow economic growth, you're normally expecting lower interest rates. We're in somewhat of a strange world right now. That may not be the case. But quality, long-term treasuries, that's high quality. probably a good place to be in almost all recessions, unless you have a recession like 73, 74, where you had a recession and you had interest rates rising because of inflation. So not always, but generally when you have a recession, interest rates fall, inflation typically is not an issue. So long-term treasuries are a great place to be. 2008, you would have loved to make 30s, 40% of long treasuries in that year. What's the second thing I might give you? Tips, and how many things you want to talk about there? Yeah, inflation's the only thing, although last year it didn't really work out. So we're learning about these asset class. So tips did badly in 2022, even with inflation. Why is that? Well, because tips are priced off the real rate. And what did real rates do last year? Real rates went from negative 0.7 to positive 1 something. So tips, yeah, that's great. You're getting inflation, but you're also getting a huge increase in the real rates. So I won't throw that into the exams. All I have to do is say, hey, are they expecting inflation or not? If they're expecting inflation, yeah, generally tips would be a good place to be. What's the next thing you would do? Mortgage backed. How many things there? So convexity is related to what? Volatility rates. You can certainly talk about the direction of rates. We were just talking about Silicon Valley Bank buying mortgages. What did that do to them? Well, gave them higher yield because they went out on the curve. They got higher expected return. They also got a lot of duration. They also got a lot of negative convexity. They got all the stuff that you don't want if rates are rising and becoming more volatile. What did interest rates do in 2022? They rose and became more volatile. So what grade would you give Silicon Valley's finance department? Can you go below an F? What are F minus would be? Yeah, they roll the dice. When you go to Vegas and you roll the dice and you bet your entire net worth, what do people call you? Probably not smart, right? Kind of crazy. Well, they got more volatile too. If you look, it's did y'all see last week? Y'all were all at the beach, right? What did interest rates do last week? Anybody remember? I was pretty shocked last week. What is today? The 20th? So yeah. So what's a one standard deviation event on the 10-year? 6.5. How many one standard deviation days did we have last week? So Monday, rates fell 18 basis points. Is that a big day? If you had an interview last Monday, would they be shocked if you didn't know what interest rates were doing? 18 basis points. How many sigmas is that? Almost 3. How often do you get 3 sigma events? Well, let's just do the actual number. So it happens about 2.28% of the time. Is that a high probability event? Sounds pretty low. What did it do on Tuesday? Rates rose. Well, how many standard deviations is that? Almost 2. Often does that happen? About 3% of the time. Pretty rare day. What did it do the next day? Minus 14. How many sigma is that? That happens about 1% of the time. What did it do the next day? How many sigma is that? More than 1. Y'all seeing a trend here? What did it do the next day? 19. How often does that happen? So what did bonds do? Did they rally or sell off on Monday? Rates fell 18 basis points. They rallied, sold off, rallied, sold off, rallied. What did stocks do? Sold off, rallied, sold off, rallied, sold off. What was the correlation between stocks and bonds last week? Well, we can see. I mean, this kind of stuff. This is pretty cool stuff, right? You are living history. This is what I do in spring break. I'm amazed by amazing markets. What was the one standard deviation on the stock market? Remember? It's a real round number, right at 1%. Yeah. Bonds rallied. Bonds rallied, stocks sold off. Stocks rallied, bonds sold off. Stocks sold off, bonds rallied. Stocks rallied, bonds sold off. Stocks sold off, not much. Pretty interesting week last week. Equal coral. It's probably gonna be a positive correlation because I'm doing the change in yields, but yeah, 0.96 positive correlation. But if you do price, 0.96 negative correlation. So last week was a very unusual. What did I say? When are stocks and bonds negatively correlated? Not when we're talking about inflation. You're talking about inflation, they're positively correlated. So was the market thinking about inflation last week? They weren't concerned about that at all. They were worried about what? Silicon Valley Bank, recession, hard landings, those kind of things. So the focus changed. That's a pretty good rally for bonds for the whole week. Rates fell. Rates fell 30 basis points last week. That's a huge drop for a week in interest rates. Pretty massive. So, all right. So that's off topic, but still not that far off topic. So that's why I was saying, Adrian took me, a long time to answer your question, but interest rates have been really volatile. That's a pretty volatile week. And you saw a lot of that last year. Even though they're going up, they're still, the actual change is pretty hefty. All right. So rates are really expected to be really volatile. You can do mortgage-backed securities. All right. What was the next one? Unis versus corporates. This is where students lose a lot of points. Boy, I said that in my PNC class. I said, students miss a lot of points in this. Make sure you don't miss this. And I had one student not even get any of them. And it's like, what can I do? What can you do to help me? And I was like, that's what I was doing to help you. I was telling you, don't miss this. So it's kind of hard after the exam to help. So how many things here? There's a bunch here, aren't there? 3 things. So you got the same thing as under treasuries. You got duration, you got quality. So that's the same. What's the last thing you have? Yeah, the taxes. So I might give you long-term treasuries and short-term municipals or something, so you have to play with. Quality, I might give you high-quality municipals or medium quality. One thing you'll know is the munis and the corps will be the same. If they'll both be high quality or medium quality or low quality. They'll both be high duration or low duration. They'll be the similar. So whatever decision you make on munis, you have that same recommendation in corporates. So what you can do is just say, I recommend underweighting municipals and corporates because they're short term. We're expecting rates to fall. I'd recommend underweighting the medium quality, mediums and corporates because I'm expecting a recession. But between munis and corporates, I recommend corporates and munis depending on the tax adjusted yields. All right. So you can talk about them together on duration and quality because they're going to be exactly the same there. And then you just do taxes. All right. What comes next? High yield. So this is in your list. You don't have to memorize this list, but how many things you talk about under high yield? Yeah, quality. I always have at least 3 or 4 students that say avoid high yield because rates are rising. I don't know any high yield manager that even calculates duration. I don't think they care. My duration is 6 years. Yeah, but you're probably gonna a third of them are going to go default anyway. Who cares about duration? You're just hoping you get your next coupon payment. So duration assumes you can get all your cash exactly on schedule. High yield doesn't usually do that. All right, what comes next? So we already did stocks versus bonds. So here, where do we go? Large cap, and then with something. Who knows what that something will be? Probably be related to more defensive, like growth stocks or low beta stocks, something defensive, because large cap is the most defensive of the cap. So probably something defensive. So how many things are you talking about there? Where you got cap and you got, well, both of them are quality. So quality related to cap and quality related to the something else. Make sure you talk about both of them. So don't say, I want to overweight large cap, low beta stocks because I'm expecting a recession. Well, I don't know if you're overweighting because they're large cap or because they're low beta. So I'd say within stocks, I would overweight large cap because we're expecting a recession. Also within large cap, I would overweight the low beta because I'm expecting a recession. All right, so have two bullets there and separate the large cap from the something else. Same thing on whatever comes next, mid cap or small cap and something else. Let's see, something cyclical. So same thing there. Now, if you up here say large cap, or recommend overweighting large cap relative to small cap because I'm expecting a recession, then you get it. You get the point in both places. So it kind of up to you how you write it, but it's the exact same thing. Quality related to cap and quality related to something else. Y'all seen my habit is to make them similar. They don't have to be. You could have large cap value stocks. The large cap is defensive. The value is cyclical. So I don't do that. But in reality, obviously, you have all of those choices. So what would come next? Developed market. How many things there? So quality. So here we're talking about relative qualities. I have to tell you, I have to give you specific information to say, hey, we're expecting Europe to do well, but US to do poorly or whatever. And then what's the second thing? Yeah, the US dollar. So you don't need to talk about currency under emerging markets because it gets really, really tricky in the emerging markets because of the way there's just so many different countries out there. It has been interesting watching the dollar here recently because watching the dollar tells you a lot about what's going on in markets. The euro today is strengthening a little bit. So they're both above parity, they're both above 1. Remember, the euro is dropping below 1 there not too long ago, and the pound was approaching 1, which is really bizarre to me. You know, my whole career, euro is 1.4, the pound's 1.7. I can't do that anymore. And then who knows what the yen is anymore. My word, I can't even think the yen because it's upside down. But so talk about the currency. I'll keep those two the same. Generally, if I'm saying Europe's doing better, I'll usually say that the dollar is weakening just to keep it consistent. But in reality, it can be all over the place. And then what's the next one? Merging. And so that's just going to be quality, just relative. I'll just have to tell you specifically. And then the last one, alternatives, and it's going to be whatever it is. You'll have at least one thing there, but you're looking for things like a weak dollar that might put you where? Might put you in some gold, high inflation, you might like some real assets. They may say something about commodity prices or whatever. So you just have to see what you have to work with and put that in there. 2022 was such a good example. High inflation. Wow, gold should do well. Did horribly. Why? Because the dollar strengthened. So you have to kind of look for that. But that's 30 minutes. I'll give you the scenario with a blank piece of paper, no notes. It's closed notes, and you just start doing it. It's nothing new that you didn't put on question 1. It's all the same stuff. All that strategy on question 1, now you just apply it here. I love this question because if you can handle this question, I'll just assure you handle this question, you're in the top 5% of finance majors out there, because a lot of them, they cover all the stuff in the textbook and then it just comes to the practical and they're like clueless. I've seen that in so many interviews. That's why you see why I do the question like this. You got to be able to convert what you memorize on all the textbooky stuff and actually put it into real life. When you interview for jobs, they're assuming you know all of this. They're shocked if you don't, even though 95% of finance students don't. All right, so this is one of those things where there's a huge disconnect between the textbook and what the employers are looking for. They don't remember how little they knew when they were in undergraduate, because they live and breathe this stuff so much, they just assume all finance, that y'all are just out there doing this every day. They just don't have a good memory. So you need to get this so you can talk intelligently in interviews. So it's really very powerful. Any questions on the exam? So you only have 30 minutes. So once I call it, so don't come late to class on Wednesday. Make sure you get here on time so you can move fast. All right. The paper 2 companies. Let me show you what I have so far. I'll get the data to you by this weekend, and you'll have plenty of time to work on it. These are just the companies that I found were interesting. If we see another one come in, I don't know if there's, I haven't seen any big ones in the news recently. Why won't they let me just use their stuff for free? I don't get it. Foot Locker. All right, pretty irritating there. Foot Locker. That is incredible that it keeps happening. I don't know what I'm going over. Moon Lake, I'm not familiar with them. Yeah, I don't see any other. These are really small companies. So I don't see anything there. Tomorrow, Nike could be interesting. Nike has been a really big mover sometimes. Tencent, I'm kind of avoiding non-US companies. So, we'll see. GameStop, I don't think that's going to be all that interesting. Because they're just doing nothing but losing money. Yeah, maybe the market gets excited they lose 13 cents instead of 16. I don't know. We'll see. I don't see anything else in there. But Nike, I'll look at Nike and see tomorrow if that comes in. But the ones I found I thought were really interesting. One is Vail with a cool ticker. You can see where their earnings report came in, can't you? Did the market like it or not? Not too excited about it. So Val's when's the last time y'all went skiing? What was the COVID impact on skiing? Did they shut them down? No. They didn't completely? And they didn't have people flying there, so that was kind of an issue. But could you still ski in 2020? I don't ski anymore. I'm 60 years old. It's the stupidest thing in the world for a 60-year-old to do. But, huh? I think if they opened back up, so maybe they ended the season early. So this is one of those coming out of COVID companies. I don't know what the snow season's been like this year. And those kind of things are interesting. But Vail Resorts, so a hotel chain. I don't know if they're entirely just ski resorts. Dick's Sporting Goods. They had an earnings report. How did that come out? Looked pretty strong, right? What did they report? It was so good, especially given that retailers, or some of them, are showing some pretty bad numbers right now. So that's interesting. Casey's, that's one of the stocks we're studying in our consumer discretionary sector. It's not a company I know much about. They came out on 3/8 right there. Doesn't look like the market liked it too much. Any of y'all ever been to Casey's or Sprouts? Have y'all been to Sprouts? I'm going to go visit one because we're trying to decide between Casey and Sprouts. I've never been in either one. I've been in a Trader Joe's and I thought it was horrible. It's like, I'll never shop here again. I don't know why people like Trader Joe's, but I guess they have a following. But Sprouts looks pretty easy, interesting to me. Casey looks different. Thor is a company we've owned before. Thor probably did great during COVID. Why would you think Thor did great during COVID? What do they sell? They sell like Winnebagos and right. So COVID, what do people do? Hey, might as well get into a big, house on wheels and just drive around the country. So they reported on 3/7. There it is. So it dropped. I don't remember how much it dropped, but they had a bad report. But if you look longer term, 2018, I mean, 2020 was a great year. They were selling. In fact, their biggest problem was supply chain issues. They just couldn't build the things fast enough. But I've thought about renting one of these. I thought it'd be pretty cool, have a road trip, and then it's like more expensive to rent one of these than it is to stay in a nice hotel. So I was like, I might as well just get in a plane and stay in a nice hotel. It'd be a lot nicer. So Thor, and then I'm going to do Squarespace. This is a really interesting company. Does some really interesting stuff. So they reported on 3/7 as well. That looks like it, doesn't it? How did the market like that? So interesting company. They just, I think they add a tremendous amount of value. They do the stuff essentially in outsourcing, right? Isn't that how you would describe them? An outsourcing company. Platform for business and independent creators to build online presence, grow their brands, manage a business across the internet. Yes, it's a firm with a good product. It's pretty inexpensive. I wish my doctor would use them because it'd be a lot better than what they currently do. Adobe, we were just talking about Adobe. It's one of our tech stocks that we're looking at. Great firm, no question. Can y'all see where they might have reported? Could have been there, but it wasn't. But right there, not sure what happened here, but right here they reported the market looks like they liked it pretty much. FDX. So they had an interest report, 3/16. The market loved them. Dollar General. They just came out and the market didn't like them. So they liked FedEx. They didn't like Dollar General. Five, I'm not familiar with Five. It's probably a place I would never shop. I don't know what Five Below means. Is that like a size of clothing? $5 or less. So it's kind of a Dollar General. Glitter lamps. Yeah, okay. So it's another Dollar General then. When they came out, 3/16. So it looks like the market reacted negatively and then changed their minds. So that could be kind of interesting. And then this last one, UiPath. You can kind of tell where they reported very, very positive numbers. UiPath is end-to-end automation platform that offers a range of robotic process automation. That sounds like a pretty interesting firm to talk about. So they do a lot of really interesting stuff. Pretty kind of topical kind of stuff. So there's the firms I have so far. If I find another one, oh, there's one more that I don't know very well at all. PagerDuty, have y'all heard of them? Does that sound familiar? So you can see very, very positive is there as well. This is not a firm I know that well. Engages in the operation of a digital operations man. Whoever writes these things doesn't write very well. I don't know if I use the word operation twice. Engages in the operations of a digital operations management platform The company's digital operations management platform collects data and digital signals from virtually all software engaged systems. So it's kind of an AI type of firm, taking your data and giving you some information on what to do. They probably hire a bunch of decision scientists. So pager data for consumer. You might call them a CRM type of firm. I don't know if that would be their category, but I think you've got some fairly interesting. You got the big guys like Federal Express and the exporting. Thor's pretty big company, Adobe obviously, and you got some smaller kind of special type. When you're deciding, I'll get you all the data, but you can start looking for articles already. When you're deciding, the bigger company is going to have more written about them. So that gives you an advantage. The smaller companies are doing really unique stuff. So you got some really interesting stuff. So you probably won't find as many articles, but you may find one really specialty article that goes in a lot more depth because it's an interesting company. So got to pick one of them and figure out where you want to really engage your time in understanding them. This could help you in an interview. There's a common interview where they say, give me a stock idea, stock pitch. You might not like Pager. You may not have done the analysis, but throw it in the interview anyway, because they'll never know. It's like, oh, this firm Pager dude, here's really interesting stuff. That's how you get points in interviews. You throw out a company, you don't throw out Apple and Microsoft. Everybody does that. You throw out firms like this no one's ever heard of, and that just sounds really impressive in an interview because, you know, it makes it sound like you're out there looking for great ideas. And I do like I like firms like Squarespace. Now, Squarespace, I don't know what their ticker is. SQSP. I don't like companies whose tickers I can't remember. But the problem is they're not making any money. So it's hard for me as a finance person to evaluate a firm that everything's negative. So eventually they're going to have to make some money. So hopefully we'll see this next. Now, just because their earnings per share is negative doesn't mean we can't evaluate them. You just can't use PE ratios and those type of things. You might be able to do a EV to EBITDA. You can do an EV to revenue. You can't do an EV to EBITDA, but you can do an EV to EBITDA. I mean, the revenue. They show an EV to EBITDA, but you're not supposed to have negative. A negative EV to EBITDA makes no sense because it doesn't really help you with anything. I mean, and here they're showing PEs for some reason here where they didn't show them before. So the numbers are all over the place. Squarespace is one of those fast growing companies that's either is going to take over the world or go out of business because some competitor is going to take them out. But I think they're impressive. I've never used their product. My charity, I've talked about my charity actually going out and seeing there's some of the products that they offer, $40 a month that might actually be pretty valuable for us to do. So they're interesting firms, fun to write about. All right, so there's the companies. You might go ahead and pick your company now, and then when I get you the data, you can start running it. Or if you want to get the data yourself, come down to the FSC in Australia. You can use Bloomberg to pull all this stuff because it's all there. Great. Any questions on any of that? So last class we did all these formulas. I want to ask you if you remember these formulas. We might have a surprise team case where I ask you that question. How many of these formulas did you know off the top of your head? At least 4 of them. Because we use these formulas all the time in finance, more than any other formulas, and you better know them exactly how they function. Very, very, very important formulas. So standard deviation, also known as total risk, that's what we use when we're looking at our total portfolio and just how much volatility there is. Beta is when we're looking inside the portfolio at a particular piece of the portfolio, especially one stock, and we want to know the risk that stock's adding to the portfolio. So we'll talk more about beta. Correlation, R squared, are just telling you how things are related and versus their means. Are they above their means? Not whether they're positive and negative together. It's asking, are they above their means and below their means? Remember, they could both be positive and you still get a negative number of correlation. Because if one's they're both positive, and one's above its mean and one's below its mean, you still multiply, you get a negative number. So it's all about where they are relative to their averages. And then R squared just squares that. So very, very important numbers. We use them quite frequently in finance. And even other ratios, like the Sharpe ratio. The Sharpe ratio has standard deviation in the denominator. So in the Trainer ratio uses beta. So a lot of our other famous ratios uses one of these things as part of the ratio. So very, very important. Not that just you know them, the actual formula, but that you know what they're measuring, what they're doing. So there's the formula. Take the difference first, then you multiply, take the average of that multiplied, and then you do something else. Why is that important? Well, all of our differences are from the mean. So all four of those are asking the question about how far are you from the mean or expected value. That's where they start. And then there's other calculations after that. So for our portfolio, you're looking at your entire portfolio or an entire kind of mutual fund. Standard deviation is known as total risk. It is the most common measure of risk that there is in finance. We use standard deviation quite a bit. Tells you how far you are from the mean. It doesn't care if you're above or below. It just wants to know how far you are from the mean. So semivariance only looks at volatility when you're below average. Standard deviation looks whether you're above, below. It's very sensitive to outliers because you're gonna square that difference. When you square that difference, you're gonna really make big differences huge, and small differences are gonna disappear. It also assumes a normal distribution. So if you have a skewed distribution, like you have an options portfolio, standard deviation would not be a good measure. So we're talking about a normal, or at least approximated normal standard deviation distribution. The S&P 500 is almost normally distributed. So standard deviation works well. This S&P 500, the stock market, it's got more noise in the tail than it should. We see more extreme events than we should based on a normal distribution, but for the most part, it looks pretty normal and standard deviation works well. It's just that standard deviation grossly underestimates the probability of 4 and 5 sigma events. Standard deviation says those are at least an 8 sigma event. Standard deviation says those are impossible. And yet we've seen several of them in the last 10 years. So they're obviously not impossible. In fact, there were weeks in 2008 where we saw one almost every single day. So at the extreme, it doesn't do a good job. So William Sharpe says standard deviation is the wrong measure of risk for an individual security. So you should have had this in 13 or whatever that first class is. So, and I don't know if they talk about beta in your stats class at all. Do they talk beta in stats? A lot of beta is kind of a finance only term. So William Sharpe, famous person, Nobel Prize winner. We talked about him earlier. We're talking about style analysis. He's still around. And I do, especially now that you've been through this class, go watch that In Pursuit of the Perfect Portfolio, that YouTube channel. It's a really good channel. William Sharpe's one of the people that gets interviewed. I think Dr. Lowe, I mean, just think about it. Dr. Lowe is interviewing Dr. Sharpe. So you have these two giants in finance interviewing each other. It's not like the interviewer is like, at the mercy of Dr. Sharpe. Like me interviewing Dr. Sharpe, I'd just be shaking, asking questions. But you have these two giants of finance interviewing each other. So Dr. Lowe, he can ask a question, and when he hears the answer, his follow-up is going to be just as brilliant as the answer he got. So so go watch that YouTube channel. Some really, really good people on there. So he says standard deviation is not the right measure for an individual stock. If you're looking at something that's a small part of the portfolio, standard deviation will not be the right measure of risk. And so William Sharpe, in the early 60s, he had this light bulb. He says total risk as measured by standard deviation can be broken into two pieces: systematic risk and unsystematic risk. So standard deviation has two components: a systematic component and an unsystematic component. The systematic component is also known as relative risk. It's also known as non-diversifiable risk. It's also known as market risk. There's all these different terms for it. But beta is the measure of relative systematic risk of a stock. The beta of the stock market is 1, so it becomes a baseline, and every other stock is off of that. 1.5 is a high beta stock, 0.5 is a low beta stock. So what we're trying to do is figure out how much relative systematic risk does a stock have. If a stock has a beta of 1.5, it has 50% more systematic risk than the average company. If it's a beta of 0.5, it has half as much systematic risk. We saw that earlier when we did bucks, right? The UCS, so beta. Defensive stocks have low betas, cyclical stocks have high betas. So we've already seen that, but that's only looking at the systematic risk. The unsystematic risk, also known as company-specific risk, idiosyncratic risk, these are risks that are very specific to the particular company, and they disappear once you diversify your portfolio. They just completely go away. So how much of a risk of a stock is systematic versus unsystematic? Well, we'll calculate that. So the beta of the portfolio is pretty simple, just like the duration of a bond portfolio. It's just a weighted average of the pieces. So if you got a stock portfolio with 100 stocks and you have all these different betas, you just take what percentage you have in each stock times its beta, and the beta of your portfolio is just that weighted average. Same thing with the bond portfolio. You have 100 bonds and they each have a duration. The duration of your entire bond portfolio is just going to be the weighted average durations of each one of those. So it's additive. It's pretty straightforward. So if you have a portfolio with a beta of 1.2 and you're expecting a recession, what might you recommend to your boss? You need to reduce your beta. How do you reduce the beta? If the beta is nothing more than the weighted average betas of individual stocks, what would you do? You would sell what and buy what? Well, small cap, but think of it just within your, let's say you're all large cap. You've got some automakers, you've got some travel companies. What would you say? We got to sell what and buy what? What would you do with Vela Resorts? Would you be buying that stock or selling it? Selling it. What would you buy maybe? Waste Management, Dollar General, right? So the only way to change the beta of your portfolio is to sell high beta stocks, buy low beta stocks to reduce the beta. How low would you reduce it? Well, it depends on how confident you are of your forecasts. The student was just asking me, is the Fed really going to cut rates now because of Silicon Valley? I said, well, if inflation comes back, no, they're not. I'm pretty sure Jeremy Powell is not going to let inflation get out of hand. He has his whole history. He's going to be a chapter in a textbook if he does that. He doesn't want to be the person in the textbook that Volcker had to come fix all of his mistakes. He doesn't want to be that Fed chairman. He doesn't want to be the 70s Fed chairman. So will he let some banks go under so that he can solve inflation? I think absolutely yes. I don't think he has that choice, but we'll see. It'll be interesting. But yeah, he's going to have to fix inflation. I saw his interview from Elizabeth Warren. I think Elizabeth Warren is a very smart lady and she understands this stuff, but she's also a politician. And I think she knows good and well what she was asking him. She knew what his answers were and knew that his answers were right. And she still asked them because when you're a politician, you're playing to the clickbait, but she understands this stuff. She knows good and well he's going to ignore everything she said and keep doing what he's doing. And I think she actually even agrees with him, but it amazes me politicians should know better. I thought he handled it pretty well. He just kind of sat there, you're being screamed at by politicians. Y'all seen that, right? Don't you let the politicians, yes or no? They want a yes or no answer. And they ask this really complicated question. And you're like, yeah, you can't answer that with yes or no. It's like, so they're playing to the cameras. I don't think it does our democracy very, very good. So they should just let Jeremy Powell just talk and they just listen because he's a lot smarter than they are on what he's doing. But anyway, so it's interesting, definitely they're going to fix inflation. What are they going to kill the economy to do? It all depends on how bad inflation is. Is it possible Silicon Bank and all these Republic Bank and Signature that they can actually cause a recession and cause inflation to come down? I doubt they're that big. My risk management class, we're going to talk about it. And I mean, they just messed up. I mean, it's just a pretty easy thing to do. Interest rate risk is one of the easiest to manage. So we'll see. But if you are going to make that argument that it doesn't matter what the banks are going to do, Jeremy Powell is going to have to keep pushing interest rates higher, push a recession, then you have to make a decision. Then you wouldn't just be making a decision about beta. You'd also have to make a decision about which sectors. So it's not always just a matter of selling high beta and buying low beta. You may also have to think about which actual industries you're going to go into. And that gets back to Dante, your point about large cap and small cap. Even that, you may have a little bit of a full growth in value. You might have a little bit of a debate. But beta is one of the things you would definitely look at. You should know the beta of your stock portfolio when you're investing in stocks and knowing what kind of bets you're making on the economy. And then, I mean, the worst thing to do is say, yeah, Powell's going to cause a bad recession. And you say, well, what's the beta of your portfolio? Oh, I don't know. Let me check. Oh, it's 1.6. I mean, that's not the way you manage money. All right. So don't have an opinion and have no idea if your portfolio is betting for or against that opinion. If unsystematic risk disappears very easily, all you got to do is go out and buy a Vanguard mutual fund and suddenly you have no unsystematic risk. And what Sharp says, well, if that's the case, you shouldn't expect any risk premium, any compensation for taking that risk. If you want to put all your money in Nike, you can do that, but your return is not going to compensate you for the risk unless you have some inside information that stock's about to take off. You better have some really good information. So it doesn't compensate you for it. Relevant risk, systematic risk is what beta is covering. That's the risk. Why is it relevant? Because that's the risk the market's going to compensate you for taking. If you buy high beta stock, you should be getting a higher expected return than if you buy low beta stock. Now, is that true? You can definitely go out and question that. There have been many, 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 many studies on this. One thing you can Google is just Google, is beta dead? And 160 million results would come up. It says about 160 million, so it might be 159 million. But is beta dead? There's from Wharton Finance. So that's probably a really good article right there. I don't know what date they wrote it. It probably doesn't matter though. Is beta dead again? Is beta dead or alive? Is beta dead? Is beta dead or alive? Is CAPM beta dead or alive? Depends on how you measure it. I've seen studies where you'd expect, if William Sharp was right, you should expect historically high beta stocks that have had a higher return than low beta stocks. There's some studies that show us the exact opposite, that low beta stocks actually have higher returns than high beta stocks. There's other people that say no, so you can go see it. Wharton's maybe the best one there because they've got a pretty good reputation for handling the math pretty well. I have my own view. I even have T-shirts that have my own view. So there's different views out there. Wharton's probably a better source than me, but I may tell you my view here as we get into it. So that's the thought process here is beta is a measure of your exposure to the economy. Higher than one betas are betting that the economy is going to be strong. Lower than one beta, or you're betting the economy is going to be weak and you want to be defensive. So beta is a direct measure of cyclical versus defensive stocks. And it's the only relevant risk you have. So let's do something you're going to have to do on paper 3. We'll get some practice with it. So I just mentioned Thor. So let's do some Thor. Let's bring in some historical data. And what we're going to do, usually betas are measured either with monthly or weekly data. All right, you can do a beta on daily data, but you usually do monthly or weekly. We're going to do monthly. And the reason we're going to do monthly is you'll notice that that's what Yahoo Finance does. They do monthly and they go 5 years, which means when you do my approach, you'll have a check digit. Your last number should be 1.78 if you did it correctly, because we're going to do rolling 5 years. So our last number will be the last 5 years, which is exactly what Yahoo Finance is showing. Okay. So they used to do 3 years weekly. Why they switched, I don't know. So if you watch some of my old videos, you'll see me doing 3 years and weekly. You're like, why did you switch? I switched because they switched. There was a period for about 6 months where it was just wrong. Someone had clicked and sourced wrong, so all the numbers were just wrong. And that lasted for, and there were comically wrong numbers, like 63.2. It's like, okay, that's not a beta. I don't know what that is. So someone hit the wrong button, and I don't know why they didn't fix it faster. I didn't know whom to call to tell them that you got the wrong numbers there. So does this look like this could be a good beta for Thor? So Thor, does that sound like a high beta company or a low beta company? Sounds pretty high beta to me. I mean, we're talking about things that cost. What do they call it? RV? $15,000 to $2 million. Some of these have Wi-Fi, and one of my students, my graduate students, his company, their whole purpose is to get Wi-Fi on these type of vehicles. It's like, wow, that's an interesting firm. So 15,000, and would you want to drive around the country in a $15,000 RV? Might not be the most pleasant experience ever. I can't imagine what a $15,000 one looks like. So yeah, it's an interesting motorhomes. Yeah, pretty expensive. So you would assume high beta there. Or we're going to bring in monthly, and then we're going to go back as far as you possibly can. And don't forget, you have to hit the apply button. And you have to download that. That's going to give you their monthly data back to 1985. What we want to use, now you notice both the close and the adjusted close look strange. The close is adjusted for stock splits. So that's the reason it looks strange. The adjusted close is adjusted for stock splits and dividends. We want to use the adjusted close. All right. I'm not sure about Yahoo Finance. They may use the actual close instead of the adjusted close, and that may be why you might get a slight difference sometimes. But we're going to use the adjusted close. And then we got to get the data. So I'm going to get, here's where it's the irritation. So just a second, let me pull some data here real quick. I'm going to provide a file to you. So we have an issue with Yahoo Finance. They used to provide monthly data for the S&P 500, and then they just stopped. And it's because of that. Let me go back just a second. This will be on the video, so if you want to see what I just did. But so because of that, I will give you the S&P 500 on a monthly basis. Because if you do it like this, S&P 500, and you do historical data and do max and monthly and apply, what do you notice is not there? There's no download button. Irritating, isn't it? There's no download button. Now you can copy and paste it, but you'll notice real quickly that the months are wrong. You'll have like 2 Marches and 1 February. So I had to go get the data myself. So what we're going to do is we'll bring in, I don't know how far back I went. We'll try, it looks like these last few are probably okay. We'll see. I'll bring them in. So October 3871, that looks pretty good. And 4080.11, 3839.5, 4076.6, 3970.15. And we don't need March because March hasn't finished yet. So we should be able to bring this over to Thor. Oh, we got to go to 2023, don't we? Wait, why didn't it come over? Oh, it did come over, sorry. So it looks lined up, doesn't it? Looks pretty good. So now we got our data. So once we have our data, what we can do is we got Thor, and we got S&P 500. So we need an HPR. What is an HPR? Holding period return. So you remember that it's going to be ending value minus beginning value plus earnings, which is 0 because that's already in the adjusted close, divided by beginning value. So Thor is, did y'all know Thor was down 4% in February 1985? Y'all probably didn't know that. The S&P was up that month. Copy that down. So what we want to do is, I need to do that. What we want to do is a rolling beta. We're going to do what? A 5-year rolling beta using monthly. We got monthly data, so we need 5 years. How many months in 5 years? 60. So we want to go down 60. So there's 5 years right there. So there's our 5 years. So how do we do beta? Equals slope. Then you have to do Thor first, right? And then you do the S&P. You'll see this. There's a video that shows you for paper 3 how to do this. So their first beta as of 5 years ending 1990 was 1.35. And I copied that down. We'll look at the very last one. The last one was 1.8. Yahoo Finance showed what? 1.78. They're not exactly the same. Why? Because they may have that March number in there. They may be using actual close, but that's close enough. If you get 1.8 and Yahoo Finance shows 0.7, you probably did something wrong. All right. So it gives you, usually it's the exact same number, but it just kind of depends. And I do think the March number has had some impact on them. I mean, this certainly, a 27% month certainly has some impact. How did it do back in 2020? They recovered pretty fast, didn't they? They had a 56% month and a 31%. So yeah, they did well. They're going into COVID. Their stock price was 75. A few months later, their stock price was 109. So they recovered really, really well. All right, so there we got our beta. So this is a high beta, this is a high cyclical firm, just like you would expect. What is their systematic? So how much of Thor's risk is systematic and how much of it is not systematic? Anybody have any guess how we calculate that? We've seen the formula to calculate it, but any guesses here? What percentage would you think for typical stock? How much is systematic versus unsystematic? How many would think the majority is systematic? Anybody? I mean, I think the majority is unsystematic. So y'all don't have an opinion. What do you think? What's more important to Thor, how the economy is doing or how their individual company is doing? What's going to impact their stock price more?
The whole economy.
Yeah, you would think the whole economy. The surprising answer is what? So for most stocks, the majority is unsystematic. We'll see with Thor, but for more. So anybody have a guess how I can figure that out? One of those four ratios that we calculated before would be the one that figure out what percentage is systematic.
Would it be a correlation?
Real close. What's real close to correlation? R squared. R squared is the percentage of a stock's risk that is systematic. So how much is unsystematic? 1 minus R squared. So we can do equal. I think there's an R squared function, but I'll use correlation. Correlation of them versus the S&P. Watch this. I picked a stock that doesn't work, but we'll see. So 24% of their risk is systematic. So how much is unsystematic? And that's pretty typical for a typical stock. 15 to 30% is systematic, and the majority is systematic. So what does that mean? When you diversify your portfolio, you're eliminating a huge amount of risk. You can ignore 75% of the risk of Thor by simply placing it in a well-diversified stock portfolio. That's pretty impressive. All right, so you'll do this on the exam. So what you're actually going to calculate is a rolling. And so what we want to do is look at some percentiles. So let's try the median. Let's try the 90% and the 1%. So equal percentile, highlight this whole thing, lock in the rows. Yeah, we're locking the rows. No, I did that backwards. On this, I want to lock in the rows and the column. So the median is 126, which is interesting because the current one is 1.8. The 90th percentile is 209. And the 10 percentile, let's see if the 10% is below 1. And it actually is. Would you ever use 0.73 for Thor? No, but they've had some 0.73. So that means if you pull up Yahoo Finance, there's a chance you'll see a 0.73 at some point. And what do you do with that? You ignore it and you use your own beta. That's what you're going to do on paper 3. So we're going to copy that down. Do a quick graph. And this is the graph you're going to have on paper 3. Takes me a second here. So there's their rolling beta. You notice early in their history, their beta was pretty low. I don't know if I can explain why that's the case, but low beta. But since about the last 20 years, their beta has been pretty high and been all over the place. It's one of the problems with the capital asset pricing model is that betas are terribly unstable. They're just, I mean, did Thor change this business radically? Probably not. It's been the same business the whole time. This last few years makes sense. So on paper 3, there's something you might actually do, or you might say, you know, this period of time is so unusual. I'm going to make my median 90th percentile and 10th percentile. I'm just going to do it from 2005 on because this period just doesn't look like the same company. It doesn't make sense to me that it'd be below 1. This looks like a Walmart here. And when's the last time? Hey, I need to go to. Think about going to Walmart and picking up some chips, or going to Thor's and picking up an RV. Probably didn't have that conversation. Those are 2 very different purchase decisions, but this looks like a Walmart. This looks like a Thor. So you got to be real careful. That's why To me, beta is not a number you just go get out of Yahoo Finance. You got to think about it. Beta to me is a forecast. This is regression beta. It's just how are the two numbers correlated to each other the last 5 years. It's not telling you anything about the stock. It's just telling you about the history. I expect Thor to have a high beta, just the nature of it. The median has only been 1.26, but that median is heavily influenced by this period here. So if I change my median and I change it to wherever 2000, let's go from 2003 to 19. And the chart looks a little different. Now my median is 181, which is where I am right now. Here's one time where you went to Yahoo Finance and picked a number, you probably have a pretty good number at that 1.8. All right, the low is still ridiculous number, 0.81. I would never use a sub 1 beta for a firm like Thor. I still remember a student come up to me and show me a project they were doing with the team. They were valuing this retail company. And she's just talking and she goes, yeah, and our beta is negative 0.65 and blah, 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 blah. And I go, wait, what? Yeah, our beta is negative 0.65, blah, blah, blah. It's like, no, that doesn't. What retailer has a negative 0.65? What retailer, when you're worried about a recession, you run as fast as you can to buy everything they have? I don't know what company it is. This was like a clothing store. What clothes do you run to buy when you're worried about a recession? Do y'all know that company? Makes no sense whatsoever. What did they do? They went to Yahoo Finance and got a number that was bogus because the stats were just messed up. That can happen. Beta can sometimes see systematic risk when it's really unsystematic. How does that happen? Well, remember beta is really sensitive to outliers. There's a chance there was a really big market day when the market was down 3%. And that just happened to be a day Thor also released really, really big news. So the market was down 2% and they were down 25%. It makes it look like, or maybe they announced really good news and they're up. Those outliers. So if they just happen on a big day for the market, just happen to have a big day of news, that's going to heavily influence their beta. And if that's in that 5-year period you're looking at, you can get a really bogus beta. I remember seeing beta for Ford Motor Company. What's it Ford Motor Company's beta be? Above 1 or below? Ford Motor Company makes cars. Well above 1. Yahoo Finance showed them at 0.65. I would never use a 0.65. And this is not only does Ford have a cyclical, it's a cyclical company, but it has more debt than almost any other company in the S&P 500. Debt raises betas. So you can see why I use the rolling one. Now, this is not what you did in your other classes. Your other classes did what? Didn't they do this? Y'all remember this? How many of y'all did that in your other classes? Maybe not. You don't, some of y'all recognize that? I don't like this because it doesn't really tell me much. It tells me the beta for that entire period, but I don't know, was this last year or 20 years ago? It doesn't tell me anything about time. You can look at that chart, you can tell me there's 2 very distinct periods of time there. If you look at Walmart's starting beta is like 1.25. That doesn't make any sense, but when Walmart started off, it was a small cap stock, much more cyclical than it is today. Well, today it's a very different company. So that history doesn't really make much sense. I can't tell you what happened with Thor here, why their beta was so low during that period of time. I will say something like in 2002, 2000, 2001, 2002, if you weren't a tech company, you had a low beta. A tech company's betas went up to 2.5. Since the market beta is always 1, if one industry's beta shoots up, everybody else's beta has to come down. I can also tell you in 2008, if you weren't a bank stock, your beta was going to be lower because bank stocks shot up, everybody else's came down. So that's the problem with beta. There's more things influencing whether something's systematic or not than just the economy. Right, well, I'll save this. So everybody knows what we're doing on Wednesday. So make sure you come here and get here on time, close book. It's not, I have students walk in the day of the exam. So this is a team project. No, it's not a team project. Everybody's doing their own individual exam. All right. All right. We'll stop it there. All right. So far for paper 2, I've added a couple more companies in there just because we got some interesting ones today. So, so a few of them, like you'll see some NMFs, not a meaningful figure. So I can't talk about a growth rate if you went from a negative to a positive number. It's just, there's no growth rate. Some people will show it as like 100 and something %, but then you don't know, or negative, you don't know if the first number was negative or the second number was negative. So I just put NFF. So if you write about PagerDuty, you'll just have to say they beat by 321%, and they went from a loss of 4 cents to a gain of a profit of 8 cents. So you just have to leave the CAGR out entirely when you talk about it. Oh, do I have PagerDuty in there twice? Wow, I guess I do, or do I? I have to go back and look. It looks like I do. I don't know why I would have. No, these are different numbers. I don't know who that is. I must have put another company in there. I don't know who that is. Let me figure out here. Oh, I know who it is. Because I don't remember typing GameStop. So GameStop, we'll be able to tell at the bottom. I don't know if GameStop's really doable because the numbers are pretty crazy, but they are up, 40 something % today, obviously beating everyone pretty well. Why? Because they finally made money. Why did they make money? Well, their revenues are down. So the only reason they're making money is they're cutting costs left and right. I haven't seen a GameStop store in a long time. I don't know what their digital presence is. I have no idea what this business is, but 16 cents per share. Margins are improving, so they are cutting costs quite a bit. But so it's there if you want to see it. It'd be a tough one to write about. Petco today, cool ticker. They beat. They matched essentially. They were slightly off, and the stock went crazy down. So yeah, they missed somewhat on earnings. They essentially met on revenues. They actually beat on EBIT, and their stock is down 17%. That seems like an overkill. 17% when they miss, about 4%. So there's something going on. I compared them to Chewy's. I didn't know Chewy's was pet until someone asked me about Chewy's. Yeah, I saw their numbers. They're going to be a tough one to write about because they have so many negatives. Nike came out. Nike's even more interesting because they beat by a wide amount. And their revenues beat by a wide amount. So what did their stock do? Their stock sold off. So that would be a really interesting one. Why did Nike beat by so much and their stock fell 5%? So it gives you something really pretty interesting to talk about. A lot of times when that happens, it's because management says something. Now, I don't always understand that because usually management's saying something about what they think the economy is going to do in the next few months or whatever, but that's just one person's opinion. Management doesn't know how Nike's going to do the next 6 months any better, than probably the market does as far as the general economic climate. So why the market would react to that, I don't know. But those are really strong numbers. You beat by 45%. They are down from last year. The revenues are up, though, pretty strong from last year. So they have some margin issues. So there you got a company to talk about the inflation side. I don't know what part of the inflation is affecting Nike, such that their revenues are up, but their margins are down. It's got to be an input because it's the gross margin that's down. So if the gross margin is down, it's rubber or cotton or something that's going on. Their advertising is under their EBITDA. So that would be an interesting one. I think that's the last one I gave you. So I'll need to save this and fix it one last time. Let me load it while I'm thinking about it. So it's under content. So under content, and then files for papers, paper descriptions, and then there's paper 2 company data. So I don't know if anyone's already picked their company. So I gave you essentially everything you need except for the discussion. So you're going to say they reported 516, expected 612, they missed by 15%, and they were 5.6% below last year. So you've got 1, 2, 3, 4, 5 numbers to talk about. Maybe you'll talk about that number there, the 5201, if it's radically different. If there's some adjustment, you might talk about. Most of these companies, it's not that huge. Same thing down here. You talk about 1, 2, 3, 4, 5 numbers. Usually on revenues, they are the same, but that's not always true. I've seen some companies where they're reported and the comparable are different. Now you notice this firm doesn't have expected and comparable gross margins. So all you can do is talk about versus last year, but same thing on the other companies though, you got 5 things to talk about. EBITDA, you don't necessarily talk about it. I'm more focused on the EBITDA margin, but you want to talk about margins. So then you want to look at the stock. You got to be real careful on the stock charts. So don't get confused. I gave you 2 days of stock market so you could see how the market was reacting going in. So this percentage change is not the change on the day of the announcement. It's the change over the 2 days. The change on the day of the announcement is down here. All right, so be real careful on that. What's in this chart here, the 331 is not going to be the same as here because this is going over, it's starting closed 2 days ago. All right, so I wanted to just see more what's going on. You can create your own charts if you like. All right, so you've got everything. So you just gotta find the discussion. To me, it's pretty cool. A firm like Nike, wow, they beat, but the stock fell. It's like it's a mystery. You know, you're trying to figure out who did it, why did it do it, what happens, why is the market interpreting it that way? And a firm like Nike, the advantage of a firm like Nike is it's a big company. There can be a lot of articles, a lot of stuff you can listen to. One thing I would encourage you to do is the earnings conference call. I think we talked a little bit about that, but if you've never listened in on an earnings call, do it so you can talk about it in an interview. All right. You can usually, they're all out on Bloomberg's, but also usually the firms, if you go to their website and go to investor relations, they'll usually have the call on their website. So you can actually listen to it there. And they're really boring calls. They can, especially the first part is really boring. The first part of the call, you got the CFO talking about really horrible numbers and making it sound like no big deal, blah, blah, blah. You know, they're it's dead tone as they can, unless it's Elon Musk. They're really, really boring calls until the very end. And then the sell side start asking questions. And that's where you perk up because the sell side knows these companies really, really well. They're going to ask the most important questions. And so if they ask a question about something, it's probably going to be important to your papers. So that's why that conference call is so important. So I encourage you to do that. Find articles, see what management's saying, see what analysts are saying. Sometimes if you get really, really lucky, especially some of these are couple weeks old, usually firms like JP Morgan, Morgan Stanley, Deutsche, they'll write a whole new company report. They'll update their analysis and put it out there. If you go to Merchant Online or go to Bloomberg, you might find JP Morgan wrote a whole analysis of the firm's earnings just a week or so afterwards. So that can be really, really insightful as well. So there's a lot of resources. Part of the purpose of doing a paper like this is you got to figure out where the stuff is. That's part of the undergraduate experience. Where is the data? Where is the information that I can find? So Merchant Online is a really good source that you can use. Bloomberg's a really good source. So I'm not going to talk paper one anymore unless you'll have questions. I'm kind of jealous. I'll get to do paper two. I'm kind of jealous because I'd rather do it, but I don't get to write it. So I get to read all of your papers, which is interesting. But yeah, I wish I could, but I can't grade my own paper. I'd be biased. So anybody decided what company you're doing yet? Which one? You're gonna do Nike? Okay. Yeah, Nike's a good one. I think I had Nike. I remember having FedEx before. So last semester FedEx must have reported about the same time. I find FedEx and UPS really interesting because UPS has their new CEO, and the way she explains it, I haven't heard FedEx say this, but people are asking Amazon Prime, my word, you have these trucks, you got this competitor, and her answer was, let them have it. That's the least profitable part of our business. Small packages going to houses is the least profitable thing to do. They can have it. We'll take the big, wide margin business, and they can have that. Yeah. As long as you work on it independently, it's not a group project. Yeah, you're gonna have to because I only gave you like 10 or 11 companies. Now, if you see another one, email me and we'll see. You can see some of these are pretty messy. Negative numbers, you make it a little tough.
So I was looking at Carnival for a little while because they have next week. They have their course due.
Yeah, it's getting a little late because you want to start pretty quick.
People are saying negatives. So I was going to ask about that one.
Well, we can see when the numbers come out, but you lose a week of research by doing that. I've been looking to see. My phone just comes up with all these warnings on earnings, and I'll see one. That's the reason I found Pager and some of the others I would have never thought of. So we'll see. We're in this weird time where the announcements are important, but there's so much other stuff going on at the same time that it kind of gets distracting. Bank stocks are just down a bunch today, pretty amazingly down today. Well, I'm not real sure what Yellen's doing. She's about 40 points higher IQ than I am, so I'm going to defer to her. I'm not going to criticize her like members of Congress are. So she's a lot smarter than I am. But I can't quite interpret what she's saying. It almost sounds like forget FDIC, we got you covered. But then I don't know if she's saying that to retail investors or to retail and businesses, and then they're saying no, and then they're saying yes, and it seems like it's causing more confusion. I think what she wants to do is say, hey, don't worry, we're going to be there, we'll figure it out. But the businesses that have $10 million sitting at a bank, that's their problem. We shouldn't, as taxpayers, be bailing someone like that out. When I was at UTSA, we had banks going under in the late 80s. I had to go all over the place, get the money moved around, and it was my job to do that. I didn't say, you know what, I'm kind of busy today. Federal government, why not just bail us out? It'd be a lot easier. We didn't do that. We had to go out and take care of our accounts. And we also had to make sure we didn't have 10 million sitting at a bank that could next week announce something. That was our responsibility. So these businesses, I know it's sad, these businesses, some of these Silicon businesses, I don't know why they have millions of dollars sitting at a bank. Doesn't make sense to me. Put it in a money market account that's at least diversified over 100 or so. So it seems like really, really bad decisions are being made. So if Yellen's saying, don't worry, we're going to bail you out, I don't like that answer, but I'm not really sure. Anybody know what she's saying? It seems confusing to me. So anyway, I don't think I think she may intentionally being unclear. You can see the banks, JP Morgan, Bank of America, bright red. I don't know why Nvidia's up, but that's part of the unsystematic risk. I don't even know who this little green one is here. I don't even know who that is. A lot of red though, isn't it? This is red for a market that was green just a couple hours ago. So it went from green to red really, really fast. For the week, it's still looking good. So, you know, the S&P has done pretty well the last several days, but then you do the month and it doesn't look so good. We're seeing a comeback on the tech stocks. You do year to date, it's kind of a mixed bag. So it's kind of all over the place. But the biggest thing I'm noticing, I'm going to talk about as investment society tonight, is the big disconnect between bond and stock markets. They're going in opposite directions quite dramatically. Today, you saw a huge rally in bonds and a big sell-off in stocks. The last 2 days, you've seen a big sell-off in bonds and a big rally in stocks. It's 9 days where they've gone exactly the opposite, 9 days in a row where they've gone exactly the opposite. And the bond market is incredibly volatile right now. The stock market, not so much. The stock market's volatile, but not unusually so. The bond market is extremely volatile right now. Why is that? What are they saying? You know, is it the Fed? Is it the banks? Who knows what's going on? The last year, pretty red, as you would expect with all the inflation. So it's interesting times. All right, so that's it for paper 2. You got some really, really good ones to work with here. I don't know what I did to need to be. Oh, I was highlighting all that. All right. So we'll talk a little bit more about measuring risk. What I want to do first is just show you mathematically what we mean by systematic and unsystematic risk. So if you can just visualize it, because it's a pretty important concept. We use it a lot. The capital asset pricing model is very, very important. So what I did is I brought in 9 companies from all different sectors: Apple, Ford, Bank of America, 3M, General Dynamics, AT&T, CVS, Walmart, and Exxon. So very, very diverse. I brought in their weekly returns back to 1986. And so just looking at this, you can even see in the first week, Apple was down 3.6, but Ford was up, and almost everybody else was down. So Ford was up. So that's one stock to provide some diversification. A few weeks later, Apple was up a bunch and almost everything else was down. And then Apple was down 14% in a week, but Ford was up 6%. And then they're both up together. They're both down together. And then you go to a wild week like October 87. But even then, Exxon was positive. So the big market crash in 1987, yeah, you have a lot of negative numbers. Well, even here, I don't know who that is. AT&T. So a lot of negative numbers, but even on a week like that, you would think in a week like that, everything would be red, but you had 2 stocks up that week. So you had some diversification in that week. You go to a week like in 2008, you get into the Lehman, you know, you got some pretty bad weeks. But then you have to remember that Walmart was actually positive in 08. So there are some firms that, you know, help diversify. So what does this mean? Well, what I did up here at the top, I got the return. So Apple has the highest return, but also did the standard deviations. So Apple had the highest return, but it's also the most volatile stock. But what happens when you combine Apple and Ford? So there's a standard deviation of Apple, there's a standard deviation of Ford. When you combine them, what's your return going to be? Your return is going to be 50% of Apple plus 50% of Ford. That's pretty straightforward. But what is your risk going to be? Your risk will not be 50% of Apple, 50% of Ford, which is right at 40%. What would it be? Well, what if we combine Apple and Ford together? So you can see the return goes to 21%, just the average of the two. But what does the risk do? The risk isn't 41%. The risk is only 32%. That's what I mean when I say risk is not additive. Returns are additive. Your return is just the average of the returns of your portfolio. But risk is not. The standard deviation of your portfolio is not the average standard deviation of your stocks. And why is that? What's that one word? Correlation, right? They're not perfect. If they're perfectly positively correlated, then yeah, the standard deviation would just be the average of the two, but they're not perfect. We even saw that with Ford. And what you'll notice is as you come down, it drops pretty dramatically. The average standard deviation of all those stocks is 30%, but the standard deviation of your portfolio is only 18.6. So your risk drops real dramatically. And that's just with 9 stocks. So what's happening here? Unsystematic risk is just falling out of the portfolio pretty rapidly. So at the very end, you probably still have some systematic risk because I only have 9 stocks. But once you get to about 20 stocks, unsystematic risk goes to 0. You don't have any left. Completely disappears. And so you'll notice it pretty quickly. The standard deviation of the S&P is 17%. So those 9 stocks were already pretty close to the risk of the market. Now, those two don't need to be the same because we could have a high beta or low beta portfolio. Do you want me to calculate? Let's calculate the beta of these portfolios. Equals slope. There's Apple versus S&P 500. So there's Apple. Ford, the highest, or Bank of America. Bank of America, with 2008, what's recently happened is probably driving that. 3M, pretty low. General Dynamics, low. Why is General Dynamics low? It does defense contracting. Government spend money during recessions, so it's low. AT&T is low. It's a telecom. CVS is low, kind of unusually. Walmart expect to be low. So looks like our beta is pretty low. Now, what's the beta of this portfolio? Can I take the average or I have to do something else? Well, that's the wonderful thing about beta. The beta portfolio is just the average. Well, it's the weighted average. So if I have equal weight, our beta is right at 1. So we're pretty close to 1 beta portfolio. And the risk of this portfolio is almost down to the risk of the market with just 9 stocks. So if you get the risk of the market, essentially you have 0 unsystematic risk. You only have systematic, and I got pretty close with just 9 stocks. So that's the advantage. And that's what William Sharp's talking about. The market's not going to compensate you for these high standard deviations because you don't have to do that. You just combine a few stocks and that declines quite rapidly. All right, so let's make sure we understand beta, very important concept. So total risk is standard deviation. It's measured, it's the sum of the 2 systematic, unsystematic. Most of the stock's risk is unsystematic. We saw that, remember the R squared, it's 75, 80% of the risk is unsystematic, although that drops during a crisis. During a crisis, more of the risk is systematic. That's the unfortunate part of diversification. So systematic risk, and this is important for your paper 3, and we'll see that as we talk about forecasting of beta. It's how sensitive is your stock to these systematic kind of risks. We tend to talk about the economy as being the ultimate systematic risk, but there are other ones out there like inflation, like interest rates. So every stock is exposed to systematic risk, but at different levels. So beta is not the measure of systematic risk. Beta is a measure of the relative systematic risk. So you can't say Apple's systematic risk is 1.4 or 1.2. You say they have 20% more systematic risk than the average stock. They're 20% more sensitive to the economy. So the beta of the market is 1. We use capital asset pricing model. It's a 1-factor model. So essentially it's calculating beta just by doing your stock against the market, assuming that the market has captured all of those systematic risks, which is true. The market does capture all the systematic risk. What's the problem with CAPM, in my opinion? is that systematic risk change as far as which one's driving the market, whether it's interest rates or inflation or oil prices or whatever. And so capital asset pricing model, it assumes you can capture all of the systematic just in the return of the market, but because the different factors change. So you have tech stocks have high betas during the dot-com crash. Bank stocks have high betas during the financial crisis. Energy stocks had high betas in 2020 because everybody's talking about oil prices falling. It just kind of depends. So betas are pretty unstable. There are other models out there. There's something called the arbitrage pricing theory. MSCI bought the bar model. So you could actually go into their website. Boy, I hate hitting escape. MSCI factor story. I don't know if that's it or not, probably not. Factor investing, MSCI. So they bought Barr Rosenthal, created this famous factor model. And then MSCI bought them out. So you can actually go to their site and look at it. And they actually show you the factors. Some of them are ones we talked about in this class. Value versus growth is a factor. So they don't just look at beta, they say, hey, is this a value stock or a growth stock? They look at market cap. Small companies have higher betas than large companies. They look at momentum. Rising stocks tend to keep rising. Falling stocks tend to keep falling. They look at volatility. We weren't supposed to do that, right? We ignore volatility, standard deviation, but they actually do look at the volatility and they put that in there as well. They look at dividend yield. They look at quality. There's some double counting in there. Remember, there's a high correlation between quality and value. Value stocks tend to be low quality. There's growth and then liquidity. Liquidity is usually on volumes, how many stocks are traded, how liquid the stock is. So there's a model that they have. So the question is, does this model do a better job helping you as a stock investor than the capital asset pricing model does? It looks more sophisticated, doesn't it? It's a factor model. So, if you can work that into an interview, it's like, yeah, I was looking at MSCI's factor model the other day. That sounds pretty sophisticated right there. You better know what you're talking about because the person you're talking about might know that backwards and forwards. But, that's a factor model. It's just CAPM is a factor model, but only has one factor, and that's the market itself. So high beta stock, more cyclical, durables, luxury goods, leisure products, low beta stocks, defensive. Beta can have it can be any number. It can be negative 4 billion, it can be positive 4 billion. And it's actually pretty easy. If you want to create a negative 1 million beta portfolio, it's pretty easy to do it. You just borrow a lot of money and buy put options on the S&P 500, and you would have a negative 1 million beta. It's not hard to do at all. So beta can be all over the place. But I generally, and this is important for your paper 3, I generally don't have betas below 0.4 or above 3, unless it's in a really extreme situation. Now I realize Walmart's beta has been negative for some pretty significant amount of time during certain markets. But even Walmart, I don't go negative in Walmart. Think about the implication of a negative beta. It means your expected return on the stock is less than the risk-free rate. So if you think Walmart has a negative beta, you would say, hey, if the 10-year treasury is paying 3.5%, I should be happy with the 2% return from Walmart. I don't know anyone that would say they would feel better with the 2% return from Walmart than that 3.5% return. So it doesn't make a lot of sense. So we tend not to go negative. How high can you go? Well, if you have a really cyclical stock with a lot of debt, that may push you way above the 3. It's possible. Some people talk about gold stocks being negative betas. They can, kind of like Walmart at times, but gold stocks were negative in 2008. So even unlike Walmart, they didn't come through in 2008. Gold was negative last year when the market was down, so it didn't really help. So my thought is there probably are some stocks that are at times negative beta, but not in the way that you would actually want to price it into your model. It's just too unreliable. I don't know any stock that's always reliably negative beta, even Walmart. So beta to me is not a number you look up in Yahoo Finance. It's not a regression number. Beta is a forecast. So how do you forecast it? We'll talk about that. That's going to be a big part of your paper 3 and exam 2. All right. So second, unsystematic risk. These are specific to the company, real specific types of issues. So you saw the day NVIDIA was up. That was probably because they announced something, or who knows what's going on with NVIDIA, because all the other stocks around them were negative. So, you know, you can look it up and see why they're positive today. They may have announced something new or something. And what William Sharp is saying is we can ignore these risks because they can be completely eliminated just by diversification. But remember, on unsystematic risk, it only applies for risks that can be diversified. So if you're thinking about a firm like HEB, if you're Mr. Butt and you're trying to value HEB, for you personally, you wouldn't use the capital asset pricing model because he can't diversify that risk. He's stuck with it. So total risk is his. And what does that mean for Mr. Butt? The second he goes public, his net worth increases like, I don't know, 500, maybe 220 times. His net worth might go from $500 million to $10 billion by simply going public. And why is that? Because the discount rate for HEB goes from 25% to 6%. What happens when you change your discount rate from 25% to 6%? Valuations don't go up 10% or 20%, they go up thousands, you know, just a bunch. So why hasn't Mr. Butt gone public? My guess is there's just not enough butts out there yet, but you go down 3 or 4 generations when there's 1,000 butts. If you're one of the butts that's, you know, several generations from now and your value in HEB is, say, it's 2 million, but if you go public, it's going to be 50 million. Would you have an incentive to go public? Maybe. So you might want to.
Well, I know, I think they're actually running out of butts.
Yeah.
I think, families.
Well, that's the thing. If you're worth 500 million bucks, and you're like, you know, 500 million or 20 billion, I'm indifferent. And I just want a company that I can run in San Antonio. You know, he can certainly do that. And if there's not, you know, if he's got, but even if he's got only has 3 grandchildren, they may want 20 billion instead of 500 million. So even with 3, I mean, just remember Mark Zuckerberg, he really didn't want to go public, but he did. Why? Because he wanted to be worth 20 billion instead of 200 million. It's just, you know, a lot of people like money. And so they like to be really rich instead of just rich. But yeah, that's the big incentive to go public is your discount rate drops dramatically because now you have something that can be easily diversified into a portfolio. All right, so we just did this down here. So I've seen exam questions, and I've heard people say this, that stock betas must have risen in 2008 because of the financial crisis. Well, that's not possible. Because the beta of the stock market's always 1. So all stocks betas can go up. So bank stock betas went up in 2008, but that means other stock betas went down. Tech stocks betas went up in 2000, 2001, but other betas went down. So you can't say not all betas can rise together. Anything that rises, something else has to go down because you have to average 1. And I've seen this exam question. You have a stock with a beta of 1.1 and the S&P is up 10%. How did your stock do? And the answer is, I have no earthly idea. And you don't. Your stock could be down 40%. All right, remember, beta only accounts for 20% of what's going on. There's another 80%. Now, if you have a stock portfolio that's well diversified and its beta is 1.1, you would expect this return to be about 11%. But even then, there's a lot of noise. There's a lot of tracking errors. So it's not that predictable. Now, if you buy an S&P 500 index fund and you leverage it up to give it a beta of 1.1, yeah, then you got some pretty good confidence. But betas are not that predictable. All right, so we're going to do rolling betas. I've already shown you how to do that once. We'll get into that. But what I want to talk about, well, we don't have much time. So I'm going to go through this once now, and we'll do it again on Monday. So how do you forecast a beta? So I do believe in betas. I do like capital asset pricing model. I know a lot of the industry has kicked it out and don't use it at all. You got to have something. I remember one firm talked to us and I was asking, what discount rate do you use? How do you come up with it? And they said, we just use 10% for everybody. It's like, what, 10%? So you're using the same discount rate for Walmart and Squarespace? Squarespace might be out of business next week. Walmart's still going to be around in 50 years. I think I need a higher return from Squarespace than I do from Walmart. No, we just use 10% for everything. So I don't think that's the right answer. I don't think using regression betas makes sense because betas are so uncertain and so volatile. So in my opinion, beta is a great input. It makes a lot of sense, but it's an input just like anything else. You're going to be forecasting growth rates. You need to forecast the beta. What is, based on your understanding of this business, what should their beta be? That historical regression is a good input. That's going to be step number 4, but it's just one input. So the first one is the most obvious thing is what kind of company is it? I say revenue sensitivity, but is this a defensive or cyclical company? A lot of times that's pretty obvious. Walmart, pretty obvious. Ford, pretty obvious. Although Ford's a little tricky. You might think Ford makes cars, but actually Ford's more like a bank than a car manufacturer. A big part of Ford is Ford Motor Credit. And that looks a lot different than if they only manufactured cars, they would be a high beta firm, but the fact that they have a banking operation changes them a little bit. But yeah, you generally think of them as a high beta. Some firms are a little tricky. McDonald's, is that a cyclical firm? When's the last time you heard someone say, man, I'm worried about losing my job, I'm gonna have to give up on going to McDonald's? No, they may go to McDonald's more because of that. McDonald's is a pretty cheap way to get calories. But is it a 0.4 like Walmart? No, to me, McDonald's is kind of a round 1 type of. So it's not always obvious, but for some it's obvious. When you pick your company for paper 3, you might let that be part of your criteria. You want a firm that's obviously cyclical or defensive to help you with that one discussion, but it's not required. So you start there, and there's degrees. Target's closer to 1 in Walmart, definitely. Kroger's is probably further away. So Kroger's is all groceries. Then you got Walmart and you got Target. Yeah, I would have Kroger be the lowest, but then Kroger's has a lot of debt. How does that affect you? So we'll talk about that. The second thing we're going to talk about, you can see I have a list that shows where I think the typical betas would be by industry, but even that is pretty debatable. There's high betas like materials and industrials, discretionary, those are high beta sectors. There are low beta sectors like consumer staples and utilities, and some that are kind of some pretty wide ranges. The second thing you want to take into consideration is leverage. And there's 2 leverages you got to do. So leverage, anytime you see the word leverage, you're magnifying returns. You're making the firm more volatile. There's 2 leverages. There's operating leverage and financial leverage. So operating leverage, that's fixed costs. A firm with more fixed costs has a higher beta than a firm with low fixed costs. All right. That doesn't mean fixed costs are bad. I was reading the firm, I forget what firm it was, but they're actually tapping into their fixed costs because they're in a growth spurt, which means as their revenue grows, their earnings are going to grow really fast because they don't have much fixed costs. But it still makes them higher beta. All right. So that may be a good strategy. They're going to take advantage of economies of scale and have a lot of fixed costs that they're going to spread over more and more revenues, but it does make them more volatile. All right. So we'll talk about that one. The second one is the obvious one, and that's financial leverage, and that's just how much debt do they have. Firms with more debt are going to have higher betas than firms with lower debt. And then the last one, that's where we actually look at the history. So we're going to go through this process on Monday. I don't know which company I'll do, but what I'm going to do on Monday is exactly what you're going to have to do in paper 3. So you're going to have all these pieces in there. So start thinking about what company you're gonna do for paper 3. All right, I'll stop it there.